Today is going to be the first episode that's talking about raising capital.
When it comes to capital raising, it's like an art and a science. You almost feel like you're begging people. People stop talking to me, block me. They thought it was a scam. Currently, I'm in about 400 doors, short-term rentals, multifamily to senior living portfolio. Somebody moves out of your property, I'm paying that mortgage 100% until somebody else moves in. And I was like, man, there's gotta be a better way. The goal is for them to come to you instead of you pushing out to them, because nobody likes to be sold. At the end of the day, investors don't care about the property managers. It's your responsibility as asset manager, because guess what? I invested with you, Victor. Asset managers need to step up and take more responsibility and accountability.
It's going to be really fun and tons of great educational content for you guys. The quick tip I have for you guys today is to remember to subscribe to the Launch REI Newsletter. We have the link in the show notes if you guys want to grab it. We've got all sorts of systems and blueprints on scaling your real estate investing and your passive income. And we share all of the best things that we're learning from our episodes that we think that you guys would benefit from. So make sure to grab that before you leave today. And we're going to go ahead and get started. Victor Collazo, we appreciate you being here, and we're excited to talk about your real estate journey. So thank you for your time today.
My pleasure. Thank you for having me on.
So your history, if we kind of go back a little bit, you grew up in Illinois, right?
Correct. I grew up in the Chicagoland area. That is correct.
Okay. Do you think that they have the best pizza?
Ooh, that's always it's a great question. But yes, I've traveled in a lot of places. I've been all over the world. Yes, they do. Even this might be fighting words for some people. Don't fight me on this. Even better than New York.
We actually had a guest on a few weeks ago who built a 1,900 unit multifamily portfolio, and he actually owned a pizza shop. It was Gino Barbaro, and he's like one of the original guys from Jake and Gino.
Mhm.
And so he kind of shared his story on how he scaled his multifamily portfolio. But yeah, we had a really good conversation, and he's a big pizza guy, and I hope to grab a slice with him one day. But let's go back to your story a little bit. So what were things like growing up, and then as you started to get towards either high school or college, how did your young adulthood kind of take shape before you got into real estate? I think it's always interesting and helpful for everyone to kind of hear what that backstory looks like, so they could kind of fit the pieces together of how you got to the things that you're doing today.
Sure. So I grew up again in the Chicagoland area in a town called Cicero, Illinois, which is right outside of Chicago. It's basically literally across the street, and you're in Cicero, Chicago. That's why people say Chicagoland. So I grew up there, went to school there, grade school, high school. I barely graduated high school. I'm very active right now. I love being physically fit and keeping active, but it has to do with high school. I graduated. I failed gym in high school, and I graduated in the summer. And I failed out of all. You would think, how do you fail gym? Right? I failed because I missed too many classes. I was doing too many things, hanging around with the wrong people. Basically, is what it came down to. So, fast forward a little bit. Had my son, and then after I had my son, I was like, all right, I got to do something. I wasn't hanging around the best neighborhoods, right area, so I went in the military. So I joined the Army. So I spent 10 years in the Army between active duty and guard. Loved my time there. Proud of my service there. Proud of every moment that I spent there. So after that, went to school full time, got my degree, and then went into the corporate world, which I've been in for a while. And then started looking at, all right, what are my options besides the whole 9 to 5 grind? What else can I do? And you don't know what you don't know, right? There's that old saying, and it really is true, because that's all I've known as an adult. At the end of the day, I didn't know about passive income or anything like that. So.
It's actually really interesting to kind of hear about your history with this, because something that I've been thinking about and talking about with a lot of people we've interviewed is there seems to be kind of this requirement where you have to reach a certain level of personal development and professional development in order to have success in real estate investing, entrepreneurship, or anything like that. And for some people, they kind of get that through whether it's high school or college, and the disciplines and the mindset that they learn in those environments, or maybe how they grew up, but sometimes it's not, and they pick it up later. I would guess that maybe you were below average on the personal development front and you had some catching up to do, you were getting into trouble, you said, and that being in the army, I would imagine that that gave you like systems and models and, a box to be in, and that they would just pull you up to the level that you needed to be at to be able to be reliable and consistent and execute and, strengthen your mindset and be serious about the things that you're doing. I would love to hear your take on what your thoughts are on that since you lived it.
Yeah, absolutely. In the military, you have to be disciplined. I mean, you don't have to. You have there kind of is a choice. If you don't, you get kicked out at the end of the day. But if you want to be successful and you want to, do what needs to be do, you have to be disciplined. You're right. There's a lot of structure involved. There's a lot of being told what to do, so to a certain aspect, but for your success, right? There is a way to move forward. There's a path you can see forward. But at the end of the day, yeah, I didn't have much of that growing up, unfortunately. So that's why I joined the military. I looked inward and I realized I needed that. I wasn't going down the right path, and I was like, I need to do something better with my life or my family in order to be successful at life. But yeah, but by doing that, that paved the way for a lot of other, for especially right now for my real estate journey right now. But it paved the way for a lot of how I do things, how I think. Even today, I still do a lot of stuff. I'm a veteran. I do a lot of veteran volunteering. I have a lot of veteran friends that I still connect with and hang out with on a weekly basis as well. But yeah, basically, it definitely shapes a lot of your mindset and your thought process.
So when you did come out of the military, what kind of work did you go into as far as like corporate life? I'm also curious, do you feel like they prepare you for certain types of roles or certain types of industries that kind of fit best?
When I got out, I wasn't sure what I was going to do. So I went to school. I got my bachelor's degree and I got my master's degree in communications and training. I'm like, great. Now what? What do I do with this? What do I do with this degree? So I actually went into project management. I learned about project management from a very good friend of mine. Didn't even know what it was at the time. And I'm like, all right, I think this might be a good fit for what I do, what I'm did in the military, whatnot, et cetera. So yeah, so I went into project management. I worked my way up from a project coordinator, implementation coordinator, to a senior project manager working on all types of IT projects, Fortune 100 companies, Fortune 500 companies.
That's awesome. Congratulations. And it's nice that you were able to find purpose and make that
Yeah.
transition because I've heard so many stories where people struggle to find their new identity and what kind of life they're going to be living after they leave the military. So it's really nice to hear a success story on that front. What was that transition like for you financially, mentally, socially?
Yeah. You hit the nail on the head. Purpose is when you get out the military, it's if you don't have a direct purpose, you know the route you're going to take, what you want to do, even though it can change, it's very very difficult. A lot of veterans get out, they don't know the purpose, they don't know where they're going to go. And that's everything because this was your brand, so to speak, right? This is who you were. This was your purpose, 24/7, 365. So getting out was tough from that perspective. I still miss it to this day. Anybody's a veteran, typically they're going to tell you that they would, but at the end of the day, I knew that chapter was done, and I knew this was a new chapter in my life. Again, and I had to figure out what to do to move forward. So it basically was just a pivot, from what I was doing, but it wasn't an extreme pivot. It wasn't like I was a mechanic and then became a doctor or something extreme. So it was in line. I was doing operations management when I left, so it was similar to what I was doing into a certain aspect.
So there was transferable skills in terms of
Yeah.
thinking about how you would work on things and structure things. And so you were able to take, it might not be the same exact job, but like you could take the types of ways that you would approach problems and work on things and have some kind of knowledge, mindset, and skill transfer so that it was able to plug into place a little bit more easily, it seems like. Now, I'm curious if there was a part of that journey when you were in the military or if it came after when you were in corporate America. Did you start to read any books or listen to any podcasts on business, investing, real estate that kind of started to pique your interest in real estate investing, or did you find it in some other way?
It was not my time in the military. I wish it was because that wasn't a big thing back then. I was in the military from 1997 and I got out in August of 2007. So yes, real estate was important, but I didn't have those connections. I didn't have those mentorships. I didn't have anybody in my circle saying, "Hey, looking to this type of investing or passive investing or whatnot. So it was after I got out, and then mainly in the corporate world, when I started working with some coworkers, and then I actually started listening to Dave Ramsey and learning how to get out of debt. And then I had another coworker tell me about Rich Dad Poor Dad, the Purple Bible they call it. you know, um, so just from basically from coworkers, and then I had a neighbor that lived across the street from me. He had, I think, 32 or 36, I forgot how many, single family homes, and learning a lot from him from the single family perspective. So that kind of shifted my mindset as well.
And how many deals have you done or invested in so far? And then we'll start to dive into those different categories and kind of break them down and talk about like the wins, the losses, the challenges. And so we'll go into each of those areas.
Yeah, so currently I'm in about 400 doors combined between the LP limited partner and GP general partner, and that's from um, short-term rentals to multifamily to senior living portfolio.
Oh, interesting. Okay, so we got quite a few things to talk about here. What was the first real estate deal that you did out of that bunch?
Out of that bunch, let me back up. It's like before that, I was a single
Sure.
family investor intentionally. Well, I own
Oh,
single family
okay.
properties intentionally before I actually became an LP, because I didn't
Okay.
even know that. I didn't know what that was, to be honest with you, back
Yeah,
then.
most people don't. Most people have never
Didn't
heard
even
of
know what
it.
it stood for. Didn't know. I didn't even back then. Didn't know I could become a GP. Didn't So so yeah, I started off in single family intentionally, but I learned real quick. Being the landlord, being the maintenance guy, being the handyman. 2 hours away to change the light bulb, so to speak. I say that facetiously, but to do even minor things, got old real quick. Plus the risk. Somebody moves out of your property. The biggest light bulb for me was somebody moves out your property. I'm paying that mortgage 100% till somebody else moves in.
Yeah.
And I was like, man, there's got to be a better way. So my first quote unquote real investment was with Grant Cardone and one of his funds.
Oh,
Um,
that's crazy. I have never heard that from someone. I am really curious what happened with that.
Yeah, again, I didn't know that I could be. You don't know what you don't know, right? So the reason I went with one of Grant Cardone his funds back. This is in 2020, I believe it was 2021. Is because it was a lower barrier to entry. I was newer to the multifamily space, and I was just learning and getting my feet wet, so to speak. And so I went to one of the events. I think it was virtual, and then I went in person, being in South Florida as well, and then learned that I could actually be an investor. That's when I started learning and understanding more about that passive investing from a multifamily space. But since then, so even to this date, I still have my investment with him, and he pays every quarter, so I can't complain.
And how have the returns looked so far on that deal compared to what was projected?
So what Grant does, they're at about 4% quarterly right now. So they're not screaming deals, but I tell people, look, he hasn't missed one payment. He pays
Wait,
every quarter.
are you saying like 4% annually, like cash on cash,
Yeah,
which comes out to be about like 1%? Okay, so just to break that down for people, like, if you put in 100K, that would mean that you're getting like 4,000 a year and you're getting about 1,000 per quarter, like in this example.
exactly. That's exactly what it is. Yeah. So, and the reason it's lower for Grant is because he invests in Class A properties or high end properties. Like you would see in Miami Beach, or maybe in Manhattan in New York. Those high rise. Basically brand new, almost brand new properties with all the full amenities. So those are great properties, but they also, because the rents are a lot higher, but but also the returns are unfortunately a little bit lower. So
Got it.
that's what he does in his team.
Yeah, it's been interesting to kind of see things like this play out. Because within our mastermind community, like we're bringing in different investors that have opportunities, that have deals that people can invest in, and so it helps kind of provide a variety of sponsors in one place, and also where people can learn and be in the same room as other people that are you know doing real estate investing, and they're not doing it alone. It
Mhm.
can be kind of lonely to be an entrepreneur or be real estate investing on your own, and you want a network of people that you trust, and it just you can have you can be a lot smarter about investing when you're with 100 other people instead of by yourself. And I think the community aspect is something that a lot of real estate investors are missing, also as they move up, like you outgrow the free real estate meetups. I run the largest free real estate meetup in the US. It's in Atlanta, and I've just noticed that there's this like top 5% of people that are actually really doing things, and they create a lot of space between them and everyone else. There's just a huge gap, and they really need their own place to grow. And they're just not going to get much value from being around a bunch of newbies that don't know anything about investing. It's just not worth their time. And then they eventually stop coming, you know?
Yeah.
But that's just like a total uh, sidetrack. So to bring this back in, so you did that. You didn't lose money on it, which is a plus.
No.
Has there been, and if it was Class A, I'm guessing, did they do any kind of value add to it so that there could be a refinance or anything? Or when are they going to sell it? Like, where does it kind of become a point where they can really deliver the bulk of the returns? Because 4% a year is really just like you could get that from bonds or high yield savings account.
Exactly. Yeah, exactly. So for Grant, they do 10-year terms.
Okay, got it. I'm let me know when that one exits because I'm curious what that ends up being like. I think I'm going to put together like a huge bank of case studies of deals that people have invested in and what the actual results were so that people can actually flip through the reality of what some other investors have invested in.
Yeah.
I just think that's something that would be really interesting, and that's not something that is available anywhere. You can't ask AI for something like that. It'll never exist.
No.
But I think I actually might gather my own little project and
Little
put
case
stuff like that.
studies. Yeah.
Yeah, I think I'm actually going to, because I have access to so many investors that have invested in deals, and I just think that's something that would be valuable and interesting. But okay, so you did that deal. You started to learn what a limited partner was, and were you an accredited investor at that time, or were you
At that
allowed
time,
to
no.
invest?
At that time, I was
Oh,
not.
so you were allowed to invest even though you were not an accredited investor.
That was part of the reason why it was a lower barrier to entry, and he was offering an opportunity um, for non-accredited investors to invest in a fund. It was a fund, you know.
Got it.
So that was one of the reasons as well.
Oh, that's so interesting.
Yeah.
That is really interesting. Um, yeah, so much of the time you have to be an accredited investor. So, and I've had a lot of people ask me, and I'll probably put together a list at some point of, sponsors that they have funds or deals or things where non-accredited investors can invest because I think that roughly, oh, I've got to look at the numbers and I don't want to give people wrong information. I think at least 10%, I think it's closer to 20. I think it's at least 10. I think it's maybe 10, 15% of households are accredited investors, something like that. It's
Yeah.
growing over time because the bar hasn't moved since like the early 1980s, where you had to have $1 million net worth or earn at least 200K a year as an individual or 300K a year if you're married. And that hasn't risen with inflation over time. So
Mhm.
it's this weird thing where a higher and higher percentage of the population is becoming accredited investors over time.
Right.
And so they've been like, at some point, everyone will be an accredited investor if the bar never moves. In like 100 years, every single person, even making minimum wage, would be an accredited investor. So they're talking about like, does that bar move at some point, or does it get replaced with like a competence test? And because it's not really about money. You could have a bunch of money and not know anything about investing, or you
Absolutely.
could have less money and you can know way more. So there's been some conversations around, should the test for an accredited investor be an actual test that you take online rather than having a certain income level?
Yeah, absolutely. Yeah, 100%. Because you can have, you can win the lotto today. You can be broke today, win the lotto tomorrow,
Yeah.
but that doesn't mean you have the knowledge or experience to understand and look at underwriting and understand what you're looking at, right? From say for multifamily, whatever the deal is, right? You may not understand what an IRR is, an AAR, et cetera. You may not understand what you're looking at. So I agree 100%. Just because you're accredited, that's why they also have the sophisticated investor, and that's why when you sign, when you do as a limited partner sign on a deal or invest in a deal, you have to fill out all the documentation saying that you understand the risks, you understand the returns, the pros and the cons of everything as well. So that way,
Yeah.
they can't come back to you and say, "Oh, you didn't know."
That's really interesting, actually. So, what kind of things, based on just where you are now, do you wish you knew at the beginning, like around that point? And then we're going to start to dive into these other asset classes that you've invested in, like the multifamily, short-term rentals, and senior living too, because I'm really curious what kind of things you've dabbled in with those and what those have looked like.
So one thing is, so I'm like you, I'm also in a mastermind as well. I'm currently in a mastermind, and I'm also a coach as well, which I never thought I would be, to be honest with you, and had no plans
Yeah, I'm
of being.
surprised. Like, I didn't think that you would be either, actually.
Yeah, I had no plans on being a coach whatsoever, and I'm very humble. I didn't feel qualified, to be honest, with the time. even with the deals I'm in. So, but anyway, so the point is that what I wish I knew then, what I know now is there's a saying, there's a power of proximity, right? And if I wish I would have known to get around those quote unquote like-minded people a lot sooner.
Yep.
Like I said, I didn't have that, earlier in my journey than I do now. Like I do now, I have a very large network, and so I wish I would have gotten to those rooms faster. I wish I would have known to, because what happens is you start immersing yourself in in those situations. That's how you start getting better, you start gaining experience, start learning. So I wish I would have learn to basically get in those rooms sooner.
And I think that you had a deal at one point where the occupancy was around 70% and you were trying to stabilize it. Was that multifamily or senior living, or which deal was that?
I believe it was multifamily. Yeah.
Multifamily? Okay. And so did you do a multifamily deal that was on the GP side where like you were the investor, you were going to be the operator, you're the one doing it?
Yes. Yeah. Yes.
Can you
I'm in
kind
one
of
right now.
Oh, can you kind of walk us through that? Like what has that looked like? And I feel like that's probably pretty scary to make that leap, especially you said that you had some single family rentals before. A lot of people tend to double and get like a small multi for 2 or 4 units and then go to 8 and then 20 or 30. What has your path looked like? Or did you go straight from single family rentals to, I don't know how many units this multifamily was, but what
Yeah.
does that look
I
like?
went from single family straight to this that I'm an LP in 200 door, but that was 200. GPA, this one is 900. I'm sorry, 92, not 900.
90 92.
92,
Okay. That's
92.
solid. That's
But no,
interesting for your first
I
multifamily deal on the GP
yeah.
side.
But I didn't just jump in. What I did first was, again, I joined the mastermind. I learned. I got the knowledge base first, so I understood exactly what I'm doing, and then I jumped on a team with experienced folks as well, experienced multifamily. Now I have my own deals and I run my own deals, but but I jumped on a team with other people, so I get to utilize the knowledge that I have plus the experience that they have as well. But yeah, but I jumped right in, and there's a courage muscle. Some people say, like you said, some people are like, I only wanted to do 2 units or 4 units, and I'm not going to discourage you to do that if that's what somebody wants to do. But at the end of the day, whether to us, 92 units to me, honestly, it's easier to manage. Sounds crazy, but it's easier to manage 92 and 100 units than it is to manage 4 units.
This episode is brought to you by Easy Street Capital, the lender built by investors for investors. Whether you're flipping, building a rental portfolio, or executing a ground up construction project, Easy Street has 3 nationwide loan programs designed to close fast with no surprises. We're talking 24-hour closings, upfront terms, and in-house servicing from start to finish. If you're ready to fund your next deal, go to easystreetcap.com/launch REI to get started, or you can grab the link in the show notes. Most real estate investors I know are overpaying in taxes simply because their CPA is reactive, not proactive. That's why we recommend TrueBooks CPA. They specialize in year-round tax planning for real estate investors, depreciation, cost segregation, entity structuring, and their clients are always surprised by what they were leaving behind. Do yourself a favor and find out what you're missing. Go to the link in the show notes and book a call with them. I would really like, if we can, to kind of break down this deal a little bit. So, because I've actually been curious about this with all the people I've been interviewing, is how do their numbers kind of shake out and compare, and are there any commonalities or ranges these things tend to fall into? So, for example, this multifamily you have, what were the projections like for the numbers? I don't know if there's other people on the GP side with you. So if you're having to split it with other people or not, or if you have investors in the deal that you have to split some of the returns with, but what do like kind of the gross returns look like maybe before those splits and things like that? So for example, 92 units, what did you buy this property for? And what do you think that like, kind of the net income is going to look like on it? What do you think the profit will look like on it per unit overall? What do you think the cash on cash returns will look like? I'm really curious what your thoughts are and what this is likely going to look like.
Yeah, sure. So again, this was a value add property that I'm on a team with other GPs as well. So this was a Class C to Class B conversion. This specific asset is built in 1983, 92 units in Wichita, Kansas. So we bought this property for 5.4 million. And then, oops, sorry, my screen just went kind of funky over there. So we bought this property for 92. Come on, sorry.
It's okay. Just pulling up the numbers. Hang with us,
Yeah,
guys.
yeah. There we go. All right. We bought a 5.4. We raised about $3 million. And so this we're projecting to hold it for 5 years. Where we bought it a couple years ago, so we're about 2.5 years in. Our estimated numbers are going to be about the 2x multiple, about 7 to 9% cash on cash, about 20% AAR, and about 15 to 17% IRR, internal rate of return.
If those numbers shake out, those would be pretty solid. And I think
Yeah.
similar to what I've heard from other people. So you're projecting an IRR, internal rate of return, that's maybe around 16%, cash on cash return, that's maybe around 8%, value add deal. And how many units was it again?
92.
92 units, 5.4 million. You're raising 3 million. How, and you have other partners in this deal. What do you think that like the profit per unit likely looks like after all of the expenses and holding back for repairs and reserves, all of that? Like, what do you think will actually be like the profit per unit before the splits with like your partners?
So we don't necessarily look at it per unit. We
Do you
look
look
at
at
it.
it differently?
Yeah, we what we
Okay.
do is
Can
we
you walk
look
me
at.
through like how you do look at it or what you guys are thinking?
Sure, sure. So what we do is that's always a great question because people ask us, well, how much should I make per unit, right? So to speak. And so is it, a lot of people will hear that should I make $100 per unit, $200 per unit, $300 per unit? And generally speaking, yeah, you want to have a target, overall, right? But at the end of the day, we have to look at our income versus our expenses, et cetera. So basically, that's what we look at. We look at our NOI monthly. We look at our cash flow, versus the HAT monthly. We look at what our returns are monthly. So we look at it on a weekly basis, month, and also on a monthly basis, holistically overall. So that's how we look at it.
Okay. And how did you guys find this deal?
So I jumped on this deal with another partner of mine. He actually found this deal off. This was an off market deal from an older gentleman that he was just looking to retire. This was somewhat of a distressed deal where there was a lot of deferred maintenance. But for us, it was a great opportunity. So, but yeah, it was a lot of deferred maintenance, and it was paid off. So basically, the person that had the deal just wanted to cash out and live the rest of his golden years.
Got it. But was it a real estate broker that brought you guys the deal off market before it got listed, or were you guys sending out direct mail campaigns, or there some other way that you have a lead generation system to find leads and find potential sellers?
So for this one specifically, this is one that again my business partner actually brought to us, and I jumped on this
Got it.
team with them. So,
Okay.
um,
Okay.
but basically, my understanding is it was through they have a lead gen as well.
And was this the first deal that you did capital raising for?
It was not.
Oh, okay. So you had done this previously for another deal.
Yes.
Um, so you've probably learned some things about capital raising by now. I'd be really curious to kind of hear about what that has been like, how you've approached that. What do people need to know before they think about raising capital for a deal?
So capital raising, there's some terms they're called dry powder, right? In other words, money sitting on the sideline and people's bank accounts or whatnot, and there's a lot of that sitting on the side. So what's been changed the last couple of years, because there's a lot of deals that's gone south, that's gone bad. People have not got and distributions. People have lost money. It's been a lot of negativity out there. There's deals that are
Yeah,
banks are holding. I'm talking to lenders where they have, they're trying to get rid of like 1,500 units at a time right now because they're just sitting on their books. It's pretty crazy right now. But there's other deals that I'm working on that are great. So, but at the end of the day, when it comes to capital raising, it's like an art and a science. When you first start, you start with the hey, let me ask your friends and family. You almost feel like you're begging people to a certain aspect. Um, but I've learned and I've shifted over time. It's just instead of asking them, first educate them. Don't ask for anything. It'll be salesy, right? Nobody likes that. Education is important because they need to understand what it is they're investing in first of all. My strategy has shifted to yes, I still reach out to people. I still talk to people, of course. I still go to a lot of networking events, but again, my network has grown over time. Um, but our last couple deals, not only have we made we've subscribed, we've actually oversubscribed. So, which is a great problem to have. We actually had to turn people away. So what we're doing now is, I always say people, instead of, the goal is, yes, you want to reach out, but the goal is for people to reach out to you. So in other words, it's the other way around. It's like, you start, saying, hey, Vince, I've been talking to you for a year, however long that time frame is. I have deals coming, I have deal flow, and the goal is for the other way around. Like, hey, I want you to come to me and say, hey, Victor, I have 50K laying around or whatever in the bank, or 100K. It's not doing anything. I'm not making any money. And over time you build those relationships, right? And the goal is for them to come to you instead of you necessarily pushing out to them, because nobody likes to be sold, right? First time I
Right.
tried to capital raise, I had people stop talking to me, block me, delete my phone number. They thought it was a
Mm.
scam.
With capital raising, are there rules and regulations around it that people need to be aware of, and what kind of structure has to be in place to be able to kind of facilitate it? Do they all wire their money somewhere? Are there any kind of documents or agreements that have to be drawn up and in place to make sure that they're doing it right?
Yes. So what we do is, there's something called a 506 B versus a 506C. It's regulated by the IRS, and basically, um, there's differences between the two. And so one, you can have accredited investors. The other one, you can have non-accredited investors, right? So there's variances between the two. But at the end of the day, you have to make sure you follow them. Also, a big thing difference between the two, excuse me, is one, you can actually market it. So I can market online. I can go online. I can tell. I can put on all the social media, go on a radio station if I want, and say, hey, I have this deal, and these are all the potential returns. The other ones, you cannot do that. The other ones, you have to talk. So there's differences between the two. So you have to understand the nuances. And again, you don't want to be you have to understand those, because at the end of the day, what you don't want to do is you do not want to be an example from the SEC. I don't want SEC knocking on my door saying, hey, you did this wrong, you did that wrong. So we use an SEC attorney. So anytime before we even post anything for capital raising perspective, I make sure I actually run that by my SEC attorney to make sure that I'm saying, that everything I'm doing is legit and legal, and I'm not saying anything that's going to warrant any issues. So definitely want to make sure that those are important. And then, yeah, paperwork. There's different portals. There's what's called, depending on if you're accredited or not. If you're accredited, you have to provide accreditation status, typically through like a CPA or whatnot. But that's usually pretty simple.
In your opinion, when would people be ready to leave corporate to do real estate investing actively full time if they're going to be on the GP side of some deals like multifamily or some of the other deals you've done? I'm curious what your take is on that, because it can be a very powerful tool. It gets you access to really good loans. Your bills are paid kind of on autopilot, and many of these real estate deals can probably be done on the side and at the same time as working a corporate job, especially if you have one that's somewhat flexible. So I'm curious what your thoughts are on, how far can you take a real estate portfolio actively while also working in corporate? Passive is a different story. If you're investing passively as an LP, you could do infinite. But if you're going to be
Exactly.
actively real estate investing, I'm curious what your opinion is on that.
I'm going to say it depends on your goals. It depends on, so when you are a GP or general partner, or you're in a deal, you're typically you're not doing this deal by yourself. You have multiple GPs in this deal, 4 or 5, GPs, depending how large the deal is. And it's going to depend on your role. And I say that because there's multiple roles, and different roles take a certain amount of time. Some take 2 or 3 hours per week. Some take 2 or 3 hours per month, right? Also depends on the asset, depends on how involved you need to be. So there's a lot of different things. Getting back to your point, right? I mean, it depends on how much time you have. If your job is flexible, if you have asset management meetings at 2 o'clock in the afternoon, are you going to be able to meet those meetings? So
Mm.
it's just going to vary from deal to deal, from role to role. But at the end of the day, if you can keep your job, and you can absolutely keep your job and do this on the side. I know doctors that are doing this full time. They have a full time job as a doctor, and they're still doing this on the side. You can absolutely 100%. Now, when you leave it, I don't recommend leaving today, if you don't have enough cash flow, or you don't have enough, basically enough to cover your expenses. Because if you don't have enough to cover expenses, then money's going to have to come from somewhere at the end of the day. So you want to make sure that you are definitely financially in that position. But making the leap from a full time employee, to a full-time entrepreneur, you're putting on your entrepreneur cap as well. So your thought process, your thinking is different. So you need to make sure you understand the pros, the risk, the challenges, right? Because there's risk to everything as well.
What has your experience been with senior living care, or however you want to phrase it? I hear different terms for it, but what have you done so far in that realm, and what has that looked like? Because it's been something I've been hearing about consistently as kind of a niche strategy,
Mm-hmm.
has a lot of complicated things to it, whether it be regulations, it's healthcare, it's a whole different type of thing. What have you done so far? I'd be really curious to hear what you've had experience in that area.
Sure. So I've raised capital for that deal as well. So I'm on a team that owns a portfolio of 4 properties in Central Florida. There's 2 in the Orlando area and 2 in the Tampa MSA, you could say, or Sarasota area. Um, so senior living is a business. Yes, there's a real estate portion to it, component to it, because obviously have the real estate from where they're actually living, but there's assisted living, there's senior living, there's memory care, there's also different components. So there's a saying, there's the riches and the niches. So but specifically what we do is assisted living. I'm sorry, we do senior living and then memory care. So the difference is between that and your typical real estate, so to speak, is again there's your when you're underwriting as a business. The expenses are higher. You have a lot more employees. You're right. There's regulation involved. You have to, you want to be closer to hospitals. You're making a lot of different your marketing strategy is different. So the business strategy overall is different, as well. The returns can be very significant depending on the location and how it's managed. They can be almost sometimes, most multifamily properties typically return about a 2x multiple on average. On senior living, we're seeing roughly about 3x, some places even more, right? So in other words, if you invest 100K, and in multifamily, that 2x, you end up with 200K as returns, right? So to speak, plus your cash flow. Same senior living, you may walk away with 300. So
It's interesting to talk about this topic because I've been thinking about this a lot lately, and I'm building out some things that are related to this, which is, we've already made the first version of this, but I want to refine it and make it a little bit more advanced. But we kind of made this tool that is kind of your asset class selection tool that people could use.
okay.
And so when you're in the earlier stages of figuring out what areas of niches do I want to go into, people, when they're in the earlier stages of this, they don't really think about anything other than the returns. You got
Right.
to think about the risk, and which is how likely you are to actually get those returns or what can go wrong. But also, you got to think about how active is this, or how much of a hassle is this? How complicated is this? I'll give you an example. If somebody is thinking about doing the kind of deals you just described, they're much more active, they're much harder to do, there's more risk, there's more hands on. If there's and I'm just throwing a number out there, if there's a 30% risk that you could lose all of your capital in that type of deal versus a 5% risk in, a mobile home park syndication,
Mhm.
and the returns for the senior living facility are 20%, but in the mobile home park they're 18. Well, then you look at the risk adjusted returns and you look at the whole perspective of the entire layout and landscape of this, and higher returns is not always better overall. And so it's going to be different asset class by asset class, deal by deal, operator by operator, and even the market conditions where they are today and what they're likely to be in the future. And so you can look at multifamily too. Multifamily deals were obviously very hot and incredible, and then rates went up a lot. And there's actually syndications where people lost all of their money and didn't get anything. And oh my gosh, I'd rather consistently get an IRR that's like 12 to 14% and get cash on cash returns that are 6 to 8. I'm just going on the lower end of what I've seen in multifamily syndications, rather than, a deal where you could lose all of your money because one loss out of 5 or 6, it just drags down your average portfolio returns so much that you know, the hassle factor of how active or passive it is, what the risk looks like, and understanding how to actually assess the risk, and then the returns of, what kind of cash flow you're getting per year, but also the IRR. Is there a refinance opportunity where I can get my money back in year 2 or year 3 so that I can recycle that capital into another deal and have my money working in multiple places at once? That's a consideration
Yeah.
too, versus if I'm just going to have to hold this for 10 years. And then what happens? If the returns are not what you think, I'm just using an example here. If the returns are not what you were expecting at year 10, well, then it's already too late. Those 10 years are already gone. So, whether it's an exit that is sooner or a refinance opportunity that is sooner or higher cash on cash returns, every single one of those things reduces my risk because it takes chips off the table. And so, kind of strategically looking at all of these factors really adds up to the whole picture. And it's really fun to kind of talk about these things because there's not a
Mhm.
lot of people that are having conversations about these things. And so it's important to have them here so that people can think about those things. Because if you're earning a lot of money and you're thinking about where you're going to put 50K or 100K, you've got to be thinking about all these things, not just, oh, this one says they're going to give me 18% returns and this one says it's going to be 15, so that therefore the 18 is better. That's just not true.
Yeah, exactly. And and there's so many factors, right? Everything looks great on paper. Everything looks good in a pitch deck. But at the end of the day, what is reality? And things change. When I teach underwriting to my students, I tell them don't get so fixated on that one number. They'll look at the whisper price, or they'll look at the purchase price. For example, they may look at something that's $10 million, and I say, look, that number is going to change. This is your business plan over the next 5 years, or how many years that you plan on holding this asset, right? Yes, you're gonna, you want to be as close as possible, but those numbers unfortunately do change. Hopefully they go up and not down. But to your point, sometimes unfortunately they go down. But that's also where your asset management comes into play, and making sure that you're on top of your property manager every single week. You're right. I've seen deals go south. I see a lot of deals go south, and it's just like there's a lot of factors to it, right? There's more than one thing, right? Sometimes the insurance just I know people where their insurance has tripled and it just killed their deal, and it's not their fault. It's not that they're inexperienced, not that they're bad operators. They did nothing wrong. They had a great asset and a great market, but the insurance just like went through the roof. And it's like, they just shop around and do their best, but unfortunately, sometimes those are external factors that are really difficult to navigate. Not impossible, but difficult, especially here in Florida.
And I think that you've done short-term rentals too. What
Mhm.
has that looked like so far? I don't know if you still have them today or if they were in the same market that you live in or other areas, but what's your experience been in short-term rentals so far?
You hear a lot of negativity around short-term rentals and Airbnbs and VBRO and all that. It's the same thing at the end of the day, right? But we don't have your typical short-term rental where you go to West Palm Beach and you're in the middle of a city and there's nothing there, and it's just a basic Airbnb and whatever. And I stare at Airbnbs constantly, right? But these are very niche. For example, we have one in Cocoa Beach, Florida, and this beautiful painting. It's right on the beach. We have a nice little golf course in the back. We're actually working on getting jet skis. So we have a family that can go to Cocoa Beach, Florida. They can stay in that house. They have everything they need. If they want jet skis, they jump on the jet skis. They have everything. It's fully immersed right there. But I mean, are we? I just we just I got a distribution for this actually today from one of them, and they're actually doing really surprisingly really well. Yeah. But I mean, again, it's just a different niche at the end of the day, right? But I also know people that's had Airbnbs, and they've struggled, and they've had to sell them, right? Because the price of cleaning has gone up, or so many different other factors, but they weren't, in niche markets. So it's just like everything. There's going to be pros, cons, going to be challenges, risks involved, and you have to learn how to pivot and adjust.
How do you see yourself continuing to develop your real estate portfolio? It seems like you are on a team or part of teams. You kind of fulfill the capital raising role. I'm guessing that some of the other partners do more of the operational aspects or deal finding. So there's these different parts to it. How do you kind of envision things developing over time? Do you think that you'll continue to specialize in the capital raising aspect of it, or start to do more in the other aspects of the deal on the GP side, or simply just do capital raising, but just keep doing more deals, more multifamily or more senior living and memory care? Where do you where do you see things going over the next, let's call it 2 years, as far as where you're wanting to continue to build out your portfolio?
Yeah, so I'm still bullish on multifamily. We still need it no matter what happens in the world, no matter what the political climate is, no matter what, no matter what wars going on, not, or whatnot, the economy, good, bad, and difference, we all need a place to live, right?
Yeah.
So you hear a lot of people, there's no good deals. We're working on some great deals right now, as a matter of fact. And so I actually do the operations side as well, on some of the deals, from terms of asset management, project management as well. So right now I'm working on a deal where pretty much we have to help with acquisitions, working with the lenders, basically pulling the entire team together. I'm starting to back off a little bit from the capital raising. I found for me personally, I don't. It's not something I still do it, but I don't like. I enjoy more the operation side more from the asset management perspective, the deal flow perspective, working with brokers, working with lenders, underwriting. I found that's more of my niche than the capital raising. So I've pivoted from that perspective, and I've actually brought on capital raisers where I know that that's what they love to do.
Yeah, and I think it's great that you recognize that, and I've kind of noticed this as a theme where people tend to find that they fit into a certain kind of role and interest on the GP side, and it's almost magnetic. Like they feel like they get pulled to a certain part of it that they really like, and they outsource or find partners for the other areas. And I think that that takes you so much further, because if you're doing something that you genuinely enjoy, you're naturally going to be so much better at it than if you're having to force yourself to do it. So I think that's really smart, and it's something consistent with what we've seen. We just don't see many instances of one person doing it all. It tends to be kind of a team of people that is doing it, whether it's two, three, four people. That seems to kind of be the range of the team size, and they divvy up the roles and responsibilities of what's needed to find, finance, take down, operate, renovate, and sell these deals throughout the lifetime of these assets.
Yeah, exactly.
Uh,
And I believe in capitalizing on your strengths, right? I know there's typically most people think, oh, well, what are my strengths and my weaknesses? Let me improve my weaknesses. And you can still do that. Don't get me wrong. But if you're great at capital raising, why would you stop? Unless you don't like it. Unless you don't like it. I mean, if you enjoy it, you love it, it's something you're great at, keep moving forward with that, right? But that doesn't mean you can't learn asset management, or that doesn't mean you can't, learn some of the aspects of the deal, right? So yeah, I love asset management. I love underwriting. So yeah, so from a that's why I decided to pivot from that perspective.
are there any like tips or strategies on asset management that you think are just, or tools, anything that you think is really useful that you just love, and you're like, this is something that every multifamily investor on the GP side needs to be using or needs to be aware of? Anything that you use that you just think is really important for people to know about or consider?
There's a lot of tools out there right now. There's a ton of tools, and a tool is just that, a tool, right? No matter how great that tool may be, it's only, it's like garbage in, garbage out, right? If you're not putting the right data in, you're not going to get the right data out. But at the end of the day, I have found that working as an asset manager, working with your property manager, partnering with them is a big, big thing. Making what I see a lot of times, what happens is asset managers, they come in, they close a deal, and asset managers like, hey, property manager, they start barking orders at them. You're going to do X, Y, Z. It's like, no, that's the wrong attitude. Partner with them and explain to them. What they don't do is, what we do different is, our property managers understand, they know we're syndicators, and they understand we have investors, and they understand that there's returns that need to be met. So we work with them and making sure that those returns are met. We meet with our property managers every single week. I know there's people that I don't know why to this day, there's whether it's in person, whether it's virtual, just depending if we're on site or not. But every single week we're talking to our property managers. And guess what? Our properties are at 94, 95%, occupied, right? Some people don't talk to their property managers for like a month. I said, you know how dangerous that is? I don't understand that. It's like, that's why deals fall apart. And then they blame the property manager. Then like, oh, I fired
Mm.
them because
Yeah.
I haven't talked to them for a month. It's like, stop blaming the property managers for everything. Yes, yes, they do shady stuff too, unfortunately, sometimes. But at the end of the day, investors don't care about the property managers. They do, but it's not. The investors are like, I don't care if you went through three of them. It's your responsibility as asset manager, because guess what? I invested with you, Victor, not that property manager. When the property manager leaves, you're still responsible. So asset managers need to step up, and take more responsibility and accountability for, protect their deal.
Yeah, you have to inspect what you expect, and it all comes down from the top in terms of who you choose to have on your team, how you manage them, what your expectations are, and how you lead them. So I think that that is some very sage wisdom, and I appreciate you sharing that, and really appreciate you sharing your story today. Where can people learn more about you if they're wanting to stay in touch with you or learn more about what you do?
Sure. So my website is extraordinaryassets.com. So I have all my contact information there, all the socials. I'm located in West Palm Beach, Florida. So if anybody's ever in South Florida, feel free to reach out. Love to connect virtually, in person, have a coffee or whatnot as well.
Victor, thank you so much. We appreciate you today.
Thank you, Vince.
If today's episode was useful, subscribe so you don't miss what's coming. We drop 2 episodes every week. And if you want to go deeper, join thousands of investors getting our free weekly newsletter at newsletter.launchREI.co or check the link in the show notes. See you next time.